Hello and welcome to the Charter Hall Direct Insight series. Thank you for joining us as we provide a quarterly update on the performance of our direct suite of funds at the end of the September 2020 quarter. For those of you who don't know me, my name is Steve Bennett and I head up our direct business at Charter Hall. There will also be the opportunity for a short Q&A at the end of today's event where I will answer a number of questions. If I don't answer your question, a member of the Charter Hall team will follow you up after the event, so please do make sure you provide us with your contact details. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds, and if you have any queries, we encourage you to consult your financial advisor and to read the product disclosure statement or information memorandums in full. As is usual at these quarterly updates, I'll go through some of the key statistics and fund information, but we'll also touch on some of the topics that are very relevant in the current market. You'll see up there on the screen the agenda which covers fund performance, the ESG side, so environmental, social and governance at Charter Hall, unit prices. I'll talk a little bit on the office sector and some of the things that are happening in this space, as well as walk through a number of case studies around acquisitions and leasing deals completed during the quarter. This slide up there on the screen shows the fund performance. So these returns are since the funds were created, with the blue bars being the actual returns delivered for our investors in that product, and the grey bar being the benchmark, which we use is the MSCI Wholesale Fund Index. Pleasingly, as has been the case of previous quarters, you can see the funds have continued to outperform the benchmark. On the right-hand side are the funds that are open for investment, and I often get asked why some of the older funds have higher returns. Well, you need to keep in mind that they were launched at different times in the cycle, times when interest rates were sitting at 5 or 6%, and you would expect the returns to be elevated for other investment classes. So what you've seen, as interest rates have come down over a long period of time, the returns for all asset classes, not just unlisted property, have tended to go down as well. And because I know a number of people who are watching today's event come through the ex-Folkestone products, it's important that we keep you updated on how they're tracking. You can see up there on the slide, the funds on the left-hand side have been open and closed. The blue bars show significant outperformance versus the benchmark. As you'd expect, some of the funds in the middle, which are backed by hotel assets, in a global pandemic where people can't travel, they've had some challenges around performance, particularly of the tenants. And on the right-hand side, you can see a number of residential funds, which, depending on when they were launched, have achieved some very strong results. But on the direct Plumpton side, obviously the team are working through a number of challenges in that market. So I've just shown you the financial performance of our underlying funds, which as an investor or an advisor is critically important. But it's equally important how we deliver those returns. And because Charter Hall is an institutional manager, we focus on the environmental, the social, and the governance side of things as well. We believe that not only is it the right thing to do, but focusing on these measures will ultimately maximize the long-term performance for our funds. This next slide is a fantastic summary of the various funds' unit prices. These are the funds that are closed for investment as well as the funds which are open for new applications. We think it's important that we provide you with this information in a nice succinct manner. And remember, these unit prices are the ex-distribution prices as at quarter end, i.e. 30 September 2020. And so before I get into a bit more detail on the open funds, it's always good to reflect on and give investors an update on the funds which are closed for new applications. The slide up on the screen right now shows the performance metrics of the Direct Industrial Fund number 2, number 3, the BW Trust, as well as DAT1 and DAT2. What they have in common is a very high occupancy rate, well, they're all 100%, very long-term weighted average lease expiries, and a focus on very strong tenant covenants. So I'll also give you a little bit more information on some of the key changes that occurred to the Direct Automotive Trust number 1 and number 2 during the September quarter. What has happened? Well, we managed to negotiate the sale of a portfolio of assets to the key tenant, AP Eagers, and we believe that was a fantastic result for our investors. We're able to transact at the 30 June independent valuation price, and we aren't an accumulator of assets at Charter Hall. If we believe it's in investors' best interest to sell assets early, we will do so. In fact, it actually costs Charter Hall management fees because we are selling the assets and returning the capital to investors a bit earlier than originally forecast. I do also recognise that we would have ideally liked to give investors greater communication around these transactions which were being negotiated. However, because any of these sales are highly confidential and because the purchasing entity is a listed vehicle, we have very strict limits on the kind of information that we can pass on not only to investors but to any third parties. And really the point where we can communicate in any level of detail is at the point when the assets are contracted. So what has happened? Well, 75% of the assets in DAT2 have been sold, as well as around 20% of the assets in DAT1. Because we want to wind these products up and funds in the next 12 months, DAT2's final asset, which is a Liverpool, New South Wales asset, has recently gone to market. In fact, we're currently running a live on-market sale campaign right now with the aim to have that property in contract either this side of Christmas or early in the new year. For DAT1, it has two assets left, an asset at Castle Hill in New South Wales and an asset in Hillcrest, Queensland. Similarly to what I just said with DAT2, we're looking to transact and sell those assets in the next 6 to 12 months, wind up the funds and return all the capital to investors. As I said, we believe that's the best interest for our investors to be able to sell those assets at attractive pricing, even if it means returning that capital back to you and winding up the fund a little bit earlier than originally anticipated. One of the things that it is worthwhile spending a little bit of time on in this quarterly update is what's happening in the Australian and in fact the global office sector. You can see here, because of COVID-19 and the global pandemic, we've had trends that have been going for a number of years and in some cases decades, but what's happened is that pandemic has sped them up. We all used to have fixed work hours. Well, that's been replaced by flexible working hours. We used to have command and control where the strategy and direction is very hierarchical and set from the top. We used to have information which was stored in silos and fragmented across the company, where it's now connected and engaged across a larger number of people. And of course, the big one, everyone used to have to come into the office at all times, whereas now you have working from home and the office is part of a bigger ecosystem. We at Charter Hall believe that the new way of working, so the flexible approach, is not going to replace the traditional office sector, but it will complement it. People will be given more flexibility to work from home a number of days a week, but that's a good thing. And we think that companies will extract maximum benefits of productivity, risk management, and collaboration by combining the best aspects of the office environment, as well as giving employees and team members that flexibility they desire. I'm also often asked, well, Stephen, in a world where many cities have locked down, and in Australian sense, the Melbourne example really comes to mind, what has that done for the amount of occupied space with your tenants? You can see up on the slide there that it really ranges. Not surprisingly, Melbourne has the lowest usage because the government has effectively mandated that unless you're critical and required to be in the office, you're actually not allowed to do so. In states and territories where the pandemic's been dealt with very well, you have an example of Perth, where the utilisation rate has gone back to where it was, or trending back to where it was pre-COVID. From a global perspective, you tend to see, again, the cities that have dealt with the health crisis have also managed to get their workers back into the city and CBDs. In fact, where you do see cities which have dealt with the health crisis, but the occupancy rate's low, it's generally because they have mandated policies coming out of a head office, often North American head office, which set the office protocols on a global aspect without paying heed to the nuances of the individual markets. And on a practical level, it means the way we've engaged with our tenants, the way we manage our office properties, has had to evolve and change because of the pandemic. You can see on the screen a number of real-life examples, such as we've provided our tenants return to work guides, which mean that we've standardised the health aspects and made sure that they've thought about all the things that they need to do to get their team back into the office safely. We've put greater levels of signage and decals throughout lifts, around the lobbies, around the kitchen areas. We've incorporated temperature screening as you enter many of our buildings, as well as a detailed lift management strategy. Obviously, the cleaning aspect has increased. In a pandemic and a health situation, you'd expect that regardless of the type of assets, whether it's an office, whether it's a medical, whether it's a logistics. And with changes to the technology, so we've created a lot more frictionless, so less touch points when you come into the office. So that's the immediate term, and what it's meant, future initiatives are also changing. We've included smart toilet systems, which include touch-free technology, doorless amenity, as well as end of trip, so bike and showers where you don't need to swipe your card or touch pads. We have antibacterial lift buttons, as well as incorporating ultraviolet handrail sanitizers and ultraviolet sanitizers into our AHUs, air handling units. So you put all these things together, and it's why our tenants like to deal with institutional managers that have professional, detailed systems in place, and importantly, people on the ground where our assets are located. And one of the implications of the pandemic is what you see in any economic downturn or recession is that the higher quality assets tend to do best. And that's because tenants wish to upgrade their premises, and the secondary assets are less desirable because they don't incorporate many of the features which I just talked to. You can see up here on the screen, assets as a proxy that are less than 10 years old typically have lower vacancy rates than some of the older stock. If you were to run the same analysis by A, B, and C grade assets, you'd see a very similar result. So then if we combine a number of these aspects, what does it mean for an investor? Well, we don't make predictions at Charter Hall. Obviously, it's very difficult, and in a global pandemic and a recession, which we're in right now, it's even more challenging than usual. But what I would say is that investors should expect, as part of any recession, that vacancy rates to increase in the short to medium term. That will not be an unexpected result. If you then fast forward to when the pandemic's over, and I'm not sure when that is, many health professionals and experts in that field don't know when that is, well, what does the space look like? Well, you'll have office assets which are trading at a huge premium to where the government long-term debt rate is. You can see up there on the slide, the spread is approximately 440 basis points or 4.4%. What I think that will mean is that investors will be looking at a world of zero, in many cases throughout the world, negative interest rates and term deposits which are paying 0 to 50 basis points and saying, how am I going to generate income? And I'm not saying what it will do to pricing in commercial property, but what I would say is that at that spread, so the yield you can get on high quality institutional grade Australian property versus that 10-year Australian government bond rate, because it is so wide that this will potentially be an attractive investment class to a large number of investors. This isn't just my opinion. I'm basing this off a number of transactions which have occurred in the Sydney and Melbourne office market. And if you look at who the buyers of these properties are, you'll note they're very sophisticated and or wholesale investors. You can see here Rialto Tower sold in April 2020, a 50% interest, and the purchaser was Dexus and a GIC joint venture. For those that aren't familiar with GIC, GIC are the Singaporean Sovereign Wealth Fund, so a huge global investor. And what that means is that they've taken a look-through cycle view and saying, if I can secure fantastic quality assets, I'm still willing to transact regardless of some of the volatility and uneasiness that may be in the short term. Peakstone, again, a Singaporean entity, acquired 45 Clarence Street, Sydney. And you can see here the passing yields and the IRR, internal rate of returns on these sales, are quite attractive pricing. Moving to 452 Flinders Street, Melbourne, that was a property acquired by Deka. For those that aren't familiar with that organisation, they are a large wholesale investor out of Germany. Moving to Melbourne, 222 Exhibition Street, another GIC acquisition, this time occurring in June. And finally, what this means is that these large, wholesale, very sophisticated investors who are buying Sydney and Melbourne office assets, they're not doing it because they believe the returns in the next 3, 6 or 12 months are particularly attractive. They are looking through the cycle saying if they can acquire high quality institutional grade assets in the gateway cities of Sydney and Melbourne, then they're still willing to do so because they are taking a long-term perspective on what that means for their investment portfolios. So whilst I've talked about some of the bigger picture impacts on the Australian office market, because this is a fund update, today's event, I'll now run through the Direct Office Fund as well as our other open funds. Well, the Direct Office Fund at $2.4 billion is the largest fund that we manage in the Direct team. It benefits from 96% occupancy and a weighted average lease expiry of 8.6 years. The weighted average lease expiry we've worked on very hard, and in fact, if you look at the WALE at 31 March, it was 8.2 years. So in a global pandemic, the active management and having people on the ground and working with our tenant customers has meant that we've been able to actively extend that WALE by almost half a year. We pay our distributions quarterly, and like all our funds, we focus on the tenant quality, so who's paying the rent. 31% government, as well as supported by Suncorp, Coles, Western Sydney Uni and Horizon, with the top 5 tenants representing 60% of the net income we receive from the fund. Moving through to the PFA fund, slightly smaller fund but still very large at $1.3 billion. It has a higher income yield, and that's largely because it plays in the space where it will require more metropolitan assets. The occupancy rate extremely high, 99%, and the weighted average lease expiry at 7.7 years is pretty much in line where it was at 31 March earlier this year. So like we just spoke about with the Direct Office Fund, we've worked very hard to maintain that long-term leases that we have in place. The PFA fund tenants are a little bit different to all the other funds which we manage, but it's different in a good way. At over 52% of the net rent roll is paid by state and federal governments, provides that very strong income security. It's also supported by other high-quality tenants such as American Express, Horizon and Lion. So this isn't an accident. This is something we've actively managed and continue to focus on for the benefit of investors in this fund. And you heard me earlier say that the expectation is that vacancy rates, regardless of the market in Australia, will increase in the short to medium term. Well, what does that mean for the 2 office funds which I've just talked about? Well, because we do focus on long-term leases, it means we've got very little expiry in the intervening years. You can see on the chart, it's heavily back-ended in terms of the major lease expiries. It means in periods of weakness in the market, we don't need to engage with too many tenants because we already have those income streams secured for the long term. Moving through to our non-office funds, I'll talk about the Direct Industrial Fund number 4, which is a shade under $1 billion of assets. We've had some great success in the September quarter in picking up high quality assets with 100% occupancy on very long-term leases. When you blend those new acquisitions in with the existing portfolio, you end up with an occupancy rate of 99% and a weighted average lease expiry of over 11 years. Again, you can see here the tenants are very strong: Ingham's, Visy, Main Freight, Browns Dairy, one of the new acquisitions during the September quarter, as well as Primo Meats. The tenancy mix is a little bit more varied and dispersed in the industrial fund, and that's because we have more properties and greater number of tenants. This brings me through to our final unlisted direct property fund, the Charter Hall Direct LWF. What have we done during the quarter? Well, we have repositioned this fund to focus on greater length of lease. We are not selling off the existing assets which focused on the consumer staples thematic because we believe that they are still strong for the portfolio. But the pandemic has shown us that there is even more value in the longer term leases than we first anticipated. At an occupancy rate of 97%, it pays distributions on a monthly basis as well as has an income yield around 6%. The largest tenants are Bunnings, Hands, Telstra, as well as Helios. And anyone that's been into a Bunnings will understand that they have fantastic tenant covenant because they're almost a monopoly in the hardware space in this country. The portfolio value is around $200 million, and what you will see is this fund will continue to grow and diversify its portfolio over the medium term. So all the funds I've just talked about in the direct property suite are unlisted direct property funds, meaning you typically have a 5-year investment time frame. Compare that to the Maxim Fund. Well, the Maxim Fund, I often get asked, what's better, Stephen, listed securities or the unlisted? Well, the short answer is it depends on what you as an investor or a client are trying to achieve. Both invest into high quality real estate, but the difference with the Maxim Fund, because they are buying stocks that are on the ASX, it has daily liquidity. That can be a real advantage to a large number of investors. But you do also need to realize that that daily liquidity comes with greater volatility in returns. That's to be expected. It is invested into stock market securities. The other question I often get asked is, well, Stephen, why would you consider the Maxim fund when I can go out and get a passive holding, an ETF, exchange traded fund, something that just tracks an index? Well, we believe that one of the benefits is we've got a high quality team that are picking the stocks. Over a long period of time, they've been able to show a level of outperformance on an after fees basis compared to the index. And up here on the screen, you'll see an active case study on Lifestyle Communities. Well, why did Maxim invest 5.3% into this kind of stock? Well, they believe it's the best of breed, strong shareholder focus, and they exhibit a very high level of capital discipline. They have not undertaken any equity raises since 2012, and in fact have been able to deliver 5-year EPS growth of 26%. They also look at what are the long-term trends driving it. Well, as more retirees seek more affordable housing options and an improving rate of penetration and institutionalization of their asset class, they believe that Lifestyle Communities is well placed. But remember, Maxim invests into a large number of these type of securities, and you're getting the benefit of a high quality team that are picking these stocks. And just like I always tell people with the direct unlisted suite of funds that they are illiquid and don't invest if you're not prepared to invest for that period of time, you need to be aware of the key risks in Maxim. Well, one of the key risks is the volatility. Because it is listed stocks, the pricing moves about on a daily and monthly basis. So just as long as you're aware of that and do your research and make sure you read the offer documents, the Maxim fund can be a fantastic way to access high quality property in a different investment structure compared to the unlisted direct property funds. And what I like to do in these quarterly updates is to give our investors and our clients an understanding of some of the recent acquisitions and leasing, as well as the management thought process behind each. The first one I'll talk about is PFA's recent acquisition of a government leased property in Adelaide. We believe at a weighted average lease expiry of 6.5 years and this price point, there's the opportunity to add significant value for our clients. One of the things which we'll be actively working on is to see if we can create a win-win scenario with the SA government as the tenant to extend that lease term out. We can provide them with whatever they need in the short term, and we can ideally target a longer term income stream for the benefit of our clients. In the industrial space, DIF4 acquired the other 50% of Edinburgh Parks, again located in SA, and it benefits from an extremely long-term lease of 19 years and 100% occupied by a very strong corporate in Inghams. Finally, it's not just the assets that you buy which derive value for your investors. It's how do you manage the assets that you already own. And a live example of what happened during the September quarter was our Perth leasing team engaged with the tenant, and what we took was a 5.7-year weighted average lease expiry, extended it by 6 years, and the tenant there is AmCap. So how did we do that? Well, that property was significantly over-rented. So we provided them with some rental assistance in the shorter term, and they were willing to extend the lease off the back of that. So they got what they want. We got longer term lease expiry, as well as we were able to achieve some valuation uplift on that asset as well. So that concludes the formal aspect of this September quarterly update, but as is usually the case, I'll now answer a number of questions which have been sent through. The first question is, are we finding many more opportunities during COVID-19? Well, I'll answer that in two parts. On the leasing side, there are definitely opportunities to engage with your tenants and create win-win scenarios. Some tenants may need some cash flow assistance in the short term, and what we've been able to do is work closely with them and extend the lease terms for the benefit of our investors. On the acquisition side, we've been able to pick up assets that other competitors haven't even been able to because they can't inspect them. It's one of the advantages of having people located on the ground, whether they're in Perth, Adelaide, Brisbane, Melbourne or Sydney. We're also seeing less competition, and as an example in the office space, assets that previously would have traded at a 5 to 10% premium to their book value are now trading at more in line with the independent valuation. So we are looking through the cycle, and we believe if we can acquire some high quality real estate in the office space, then that will be a great opportunity for our investors. The next question is, what impact has COVID had on the demand for Australian commercial properties? Well, look, I spoke earlier about some examples. The wholesale offshore investors are still very much looking at acquiring that institutional quality assets. But obviously, the volume of transactions has decreased materially. In the office space, anyway, if you look at the industrial and logistics sector, that's running very hot. You've got a lot of investors who want to actually upweight to this sector, and anything that comes on the market in that industrial and logistics space is usually very well bid. One of the strengths that we've been able to deliver for our investors in DIF 4 is we've been able to pick up a number of assets in off-market capabilities. The next question is, so given what you've said about the future of office, does Charter Hall think there will be much impact on the funds? Well, look, as I said, I'm not going to forecast. I will expect, and people do expect, vacancy rates to increase in the short to medium term. I know our income streams are well secured because of the length of lease terms, and we're actually looking, as I just said, if we can get quality assets, then we're being very fussy, but we think if we can unlock those, it may be the time to pick up assets that aren't as bid on or competitively bid as you would normally be the case. How many acquisitions have you got in the pipeline at any one time? Well, look, because of the nature of acquisitions, they're usually highly confidential. I can't give investors the information that I would like to give in real time. By its very nature, we can really only report and give investors an update on the transactions once they've occurred. But what I would say is we do have a very large transaction team at Charter Hall. We've got fantastic relationships in the market with agents, with tenants, with corporates on that sale and leaseback. And rest assured, there are a number of things which we are looking at, which if they pass our filters and screens and we manage to acquire them, we do think they will add value to investors in the medium to longer term. From a tenant's perspective, why would they lock themselves into properties for such a long time? Look, that's a very good question. Usually the tenants that we're engaging with are your government and large corporates. Because of the size of their workforce and because of their institutional needs, they have a greater certainty on their space requirements for a longer period of time. It does obviously get a lot more challenging when you're dealing with small and medium enterprises or companies that are in that high growth phase. In many of those cases, they won't even know their space requirements in 2 years' time, so they won't be in a position to commit for a 10-year term. So what I would say is many tenants aren't in a position to commit long-term, but often the tenants that we're engaging with do know that they have a minimum space requirement, and if they can work with the landlord and get maybe some additional capital or some lower rents, then that may make sense for them to commit for the long term. The other reason why they may invest for the long term or in that property, I'll take the example of Western Sydney University, which is a vertical campus. That property suits their needs down to a T. So are they going to move? No. So it doesn't make sense if they're going to give us extra term to get something in exchange. Well, it does, and that's how we like to unlock value. If I'm already invested in some of your funds, should I be looking to add Maxim to my portfolio as well, and why? Short answer, I can't give financial advice. There's a reason that disclaimer is at the start of all these events. But what I would say is that Maxim is just another way to access high quality commercial property. It's a liquid fund, but it does have greater volatility. And if it is something that you're interested in, like all our products, simply read the offer document and consult your advisor where you have one. The next question is, how long do I need to be invested in the funds for? It's a good question. I always tell people to look at the major liquidity event or review event in the direct suite of funds. Whilst these funds may have what we call limited 6-monthly liquidity, please do not invest if you believe that you're only investing for 6 or 12 months. Unlisted property, it should be invested to the medium to long term. What that usually means is there's a 3 to 5 year period, and it really just depends when the last liquidity event is. All those direct funds have rolling 5-year review events. So if the last one was 2 years ago, you still have 3 years to go before the next major event. Similarly, Direct Industrial Fund does have its review event at the end of next year. But again, you should always think of investments for the medium to longer term. I would actually say the same thing with Maxim. So even though it does have daily liquidity, you shouldn't necessarily make these kind of investments if you think you need the money in a month, 6 months, 12 months. Invest for the medium term, and you would do the same if you're investing in your own residential property as well. What is Charter Hall focusing on as a fund manager in the future? Well, I think if the global pandemic's shown us anything, is that the security of the income stream is even more important than ever. And when I talk about the security of the income stream, It's all manner of aspects. So it's who's paying the rent, how long's the lease, what level of occupancy rate do you have at the property, and what quality property do you have. I would encourage you not to get on the latest hot topic or trend. Look through the cycle, look for managers that have managed for a large number of years. At Charter Hall, we have almost 30 years experience in managing property in this country. The other thing I would say to focus on is the level of debt. We believe in 25 to 40% gearing levels. I could always increase the level of returns for our funds and the distribution rates simply by putting a higher level of debt, but we don't think that's the right thing to do from a risk point of view. So whether it's Charter Hall fund or a competing fund or any asset class, in fact, always just be mindful of the gearing. And so despite the interest rates and the cost of debt being at record lows, you need to be prudent and only go in with the level of debt that you're comfortable with. Thank you for joining us today. We'd love to get your feedback. We will send you a 2-minute survey to ensure we improve your experience at our events in the future. If you have any questions on something you've heard today or anything else, please do get in contact with our team who will be more than happy to assist. Thank you.